Hey guys, it's Dale the Options Guru here at Think Tank Trading. Thanks for joining me tonight. So I told everyone over the weekend I'm going to show you guys an introduction to options, okay? We're finally getting into the options. What I am going to do to help everybody that's new to this, I'm not going to use a bunch of large words and terminology and make it confusing. What I want to give you is just a very basic understanding of what an option is. That way you can see the big picture and then all fine-tune all of the Greeks and everything as we go along. But for today, it's going to be very basic structure. That way you guys can just understand what an option is and what it does and how profitable they can be. So we're going to give you guys a few examples right here. So first off, you would ask yourself, why buy an option over simply just buying equity, all right? So the reason you would want to buy an option is one, the cost in regards to the potential returns, and secondly, it's something that you can just trade very quickly in and out of. And I want to give you guys a quick example. So I'm on the ticker AAPL. This is just Apple, very popular stock. Options are traded heavily on the stock. So use this example. Apple is $131.46 right now, okay? If you were to buy 100 shares of this right now, move your decimal over 2 times, it's going to cost you $13,146, okay? Just for 100 shares. So if this goes up $3, you know, you can make $300. That's it, off that $3 move. It's not to say that Apple long-term isn't great, because it is a great company. I can imagine it's going to keep going up over time. May have its pullback, but a $3 move on an option, now you're talking about some serious money quickly, okay, in regards to percentages. So I'm going to show you a quick example, but first I want you to have a better understanding of what it's doing, okay? So an option is basically a contract and an agreement. All right, and I'm going to give you a quick example. So we go to the options chain. This is on Webull. Okay, so you see Apple right now is $131.46. Okay, right here, this is for May 7th, 2021. We have 132, 133, 134, 135, 136, and so on. Okay, this is called out of the money, and then you have the ones anything at this price or below is in the money. That's the phrases that and terminology that you're going to hear on that. The farther out of the money the contract is, the cheaper it's going to cost. And that's because of probability. The probability of Apple hitting $145 by May 7th is pretty low. So these options currently cost $2 and $3 for the bid and the ask, and there's almost very little volume and open interest on these things. So as you get closer to its current price, you see the open interest 19,000, 21, 36,000. Now there's a lot of people this way that believe it can. And believe it or not, actually the open interest down here is high, but you know, the probability of 145 is very low, guys. You would maybe for a lotto play like you hear, but I wouldn't go into heavy on a play like that. Probability is not in your favor. So the first thing I'm going to show you is this right here. So instead of buying 100 shares for $13,000, now I can own the rights to 100 shares. So let's just say the 135 call for 44 is the bid, 48 is the ask. So the reason you see this is just the amount of bids there are and the amount of people, the asks that there are. You're going to have a ton of different bids and asks on there, and it's going to give you a mid price. The mid price on the bid and the ask is always whatever is the middle or the difference between the two, okay? Example, if the bid is 0.10 and the ask is 0.20, your mid is going to be 0.15, all right? Now you can set it up to buy at the bid, you can set it up to buy at the mid, and you can set it up to buy at the ask. And you can customize these things because sometimes you are going to have to change those things. A lot of times you'll want to buy at the bid and sell at the mid because sometimes you're trying to get out of those contracts quickly You simply can't just hold to wait for that ask, because that ask drops quickly. These options move extremely fast. As you guys can see, this is just Friday, and you can see this one was down 70% just in one day. All right, and that's not even including a spike on the day. It probably went up even higher than that. So the difference of its peak on the day and where it's at now is probably much more than 70%. But you can make 100% or 500% or 1,000% return on an option in a matter of a couple days sometimes, and we've done it many times. So the second thing I'm going to show you guys is this. Now that, let's just use it as an example, let's say by May 7th, 2021, okay, and you can change these dates. As you scroll down, you got May, June, July, August, September, all the way into 2023. You can buy an option extremely far out. Just know this, the farther out the option is, the more cost for the options premium, all right? The closer, the cheaper. Again, just probabilities. By 2023, I'm sure most people think that Apple will easily hit $135, probably much more than that. So that's why you're going to pay a lot more for more time, okay? But right now, just by May 7th, it's still a pretty big risk. You know, if the market pulls back tomorrow and we go away from this 135, these options are going to go down extremely fast. So the first thing you want is a really good chart setup and a bunch of other things that I'm going to show you in a minute, but I'm just going to cover this portion of it for right now. So I get the rights to 100 shares of Apple for $45, let's say, and if Apple, it doesn't even have to go to this strike price, all right? Apple does not have to reach 135 by May 7th. As soon as Apple goes up at all, these options are also going up immediately. You can sell them at any time. Don't ever think that you have to hold these things until it hits the strike. You can buy it and sell it 20 seconds later if you wanted to, and sometimes that's exactly what we do. But the probability is going to be factored into what's called theta over here. I'll get into theta a little deeper later on. Those are not the primary concerns for what I want to show you guys right now. The primary things I want to show you is implied volatility, open interest, okay? And we'll get into delta and gamma as well. But implied volatility is a percentage that's factored in based off of the stock's volatility, okay? If it's not a very volatile stock, let's just use something, for example, let's say Procter & Gamble. We go to the options chain. You look at the chart on Procter & Gamble. Historically, it doesn't really move a whole lot, although it's had a little bit of volatility lately. But you look at the implied volatility on Procter & Gamble, and it's under 14 to 18%. Very, very, very low. Same thing with Coca-Cola, Johnson & Johnson, Merck, things like that. All real low IV. Now, if you go over to, let's say, Riot or Mara, one of these very volatile stocks, now you look at the implied volatility on these, and it's 150%. And that's because you look at its chart, extreme volatility, right? So you may ask, you know, why is that important? Why it's important is implied volatility is factored into the cost of the premium, okay? So Riot is $41.83 for the stock, all right? $41.83, and an option on this, let's just say, you know, slightly out of the money, $41 call, $43 call. These are $200 for one option for a $41 stock. Now, if you go over to Procter & Gamble, and this is a $133 stock, okay? So triple the price of Riot, and look at the options premium, $20, $7 to $14, $40 to $45, all right? The option costs that much less because of this implied volatility is that much lower, okay? And that's important because you want to find a good balance on these. You don't want to buy extreme high implied volatility options, because when the volatility goes away and the stock trades sideways at all, that implied volatility comes down, and your options premium comes down, even if the stock goes up, you can still lose on it. So say you buy Riot at $40 and you get a $50 call and it trades between $40 and $43, kind of some sideways action. As you get closer to that date of expiration, your option's just going to go worthless. It's going to just get eaten up by what's called theta, okay? So always keep that in mind when you're looking at low implied volatility and high implied volatility. Now, you always want an option that has high open interest. High open interest typically means there's a lot of people trading it, or a lot of people that want to trade it. You can look at open interest and volume. And believe it or not, the highest open interest ones that you'll see a lot is a lot of metal stocks. You look at FCX, this is a copper. So look at the open interest on this. And this is just May 7th, 5,000. But if you come out farther, let's say May 14th, or you go to the monthly chart, now you start to see 26,000 or higher. And this is not even as well known as some of the other ones. But kind of getting off track here, let me jump back over to Apple, go to the options chain. So $135 call, $44 to $48. We're going to get it for close to $45. You look at Apple's chart, and it's essentially at a support level right now, okay? Apple had its nice little run up into earnings, and once it lost this level, it's held the support level all week. So you can see it bouncing off support here, 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 and then two more times just now. It's literally consolidating directly on its support line. It just hit 139.50. So sitting at 131.52, if you bought a $135 call and this thing goes back up towards 138, that option would be worth hundreds of percent just in a couple days. So by buying one contract represents the rights to 100 shares of Apple at the strike that you picked, which is 135, okay? So you own the rights to 100 shares of Apple at $135 for $45. That's what that means. And no matter what Apple goes to, you own the rights to those shares. Apple can go to $200. It can get crazy news and go to $300. Very, very unlikely, but the point is you own the rights to 100 shares at $135 no matter what. Now, if you do want to exercise an option, it does have to be in the money. It has to be over that strike price, okay, for that thing to be profitable. Otherwise, the closer you get to your expiration, it's just going to go to zero, all right? And that's why options can be so lucrative, because you look at something like Tesla. Let's jump over to Tesla real quick. And let's say before this big rally, and you can really see where this thing broke out coming into last year, right? Let's look at it on the daily, actually. So this thing was trading between $320 and $500. Went through a elongated period of consolidation right here. It broke its downtrend and then went on a full breakout up to $900. So at $350 down here, if you bought a $500 call on Tesla, probably very cheap at the time, especially if it had a pretty close expiration, right? So you own the rights to 100 shares of Tesla at $500, no matter what it goes to. Now Tesla goes to $900. You're talking about some serious millionaire maker money right there. But the fact is that contract is your rights to those shares. Now, as Tesla went up towards that 500 and passed it and went towards 900, the implied volatility also goes up with the volatility. Now, what do I mean by that? I'm going to jump back over to Apple. Okay. And I don't mean to jump around a lot, guys. I know it's going to seem confusing, but let's just use this for an example. So you see the 135 call for Apple, implied volatility, open interest 36,000, IV, let's say 35%. We'll make an even number. So if volatility or a big spike comes in Apple, and this implied volatility, let's say, goes to 70%, Now this premium, which is $45, is also going to double. Okay, so it costs $45 here, your IV goes to 70%, and your premium that's at $45 is immediately gonna go to $90. So you would double your money per option just if the IV doubled as well. Okay, and whatever the IV goes up, it's just going to be the same thing. It may not double, but it could most certainly go up by 10% or 15% at times on some of these stocks, especially going into earnings or a known catalyst. If you guys ever want to look at the history of the option to see how much they are worth, you can always go back in time. All right, so we have the May 7th 2021. Let's just use the same one. Let's look at this $135 call, right click on it, go to view quote, and it's going to take you back into this thing's history. All right, so we've put it on the 1 hour. You can see that this thing right now is worth $44. This is where it's at right now. Okay, and you go back in its history, and you know it used to be worth at its peak right here $456 per option. That's how much this Apple call was worth right here. Okay, $456. Right now it's at $44, way under where it even started at. Okay, so if you would have bought this Apple contract, that you can see this is in April, you could have bought it right here. Let's just say for $100. We'll make it a nice even number. If you bought it for $100 on April 3rd, by April 19th, this one would have almost quadrupled or 5x'd. So this would have been worth a 450% gain on this 135 Apple calls. Now you can go back and look at all the different calls for Apple, $125 calls. You can see what those were worth. These are worth $635 now. They're now in the money, but you can see just recently they were worth almost $1,200. So these were also doubled. And that's just to show you guys how quickly these things move. You can see this one started back here, and it was almost $200 per option. It went from $200 all the way up to $1,100 a piece. Now that is for every single option that you buy. And reason being, Apple on April 6th, now let's go back to the actual chart and see what Apple was worth on April 6th. You can see right okay, it was worth $128. So as this went from 128 to 137, that move was a 500% move on those options. Now I'm going to show you a couple more examples just so you guys can get a feel for it. So let's go to Amazon, since it just made a really strong move. All right, you look at the whole chart on Amazon, you can see its first rally all the way up to all-time high right here. You can see its previous support level here. It tested support again. It tested that same support again here, and every time it's rallied off of it. Now it's pushing all-time high again after the last earnings. So you can go back, and Amazon is now at $3,467 per option. So let's go over to the options chain and look and see what we have. So $3,500 calls are $3,245 to $3,400 per option. Okay, now these are expensive, but again, this is representing 100 shares of Amazon at over $3,000. So that would cost you a boatload of money just to buy the equity in this. So this is still a steep discount. So coming over here to the 3,500, let's view the quote on this and look at how much this one used to be worth. So right now it's at $33.85. This is on 4/30, so just Friday. Just going back to the 29th, the day before, it was worth $9,700 per option. So you can see tripled. It lost that much just in a couple days as Apple fell. So same thing, if you go back to 4/26, these were worth right around almost $3,000 a piece right here, but they went to almost $10,000 a piece. So you're talking about $3K to $10K per option just in a couple days on that move. So that just goes to show you how quickly these options move and how much money there is to be made on them. Now, I'm going to jump over to our Discord real quick and show you guys something. So you guys know Kindred in our room. For all of you guys that are members, he calls options out all day, every day. He takes quick scalps, 13%, 50%, whatever he can get as fast as he can. He's in and out, guys. He took this account from $10,000 on the beginning of March all the way up to $183,000 just scalping. So I'm gonna go back here and show this to you guys real quick. All right, so here we are, and you can see it right here. I'm just gonna click play. So you can see right back here with 2K all the way to over $180,000 just scalping options just in the last 60 days. This was the challenge for our room, and he absolutely crushed on it. Every single play is right here, every percent, everything. Now he can't hit on every single one of them, but we do a lot of research into a lot of these plays. Me and Emily did get you guys in Disney on Friday, which looks like it's going to open up for a pretty solid day tomorrow. So just for a brief overview on a couple things. So if you're not scalping and you want to swing trade options, you have to buy at these support levels leading into some sort of catalyst, okay? Now, if you would have bought Apple at trendline support right here and know that it had earnings coming up right there, now that's a swing trade, because you can buy at 118 and you could have just swung these options straight into earnings, sold right before earnings, or maybe even held a few of them through. But that's how you would swing trade an option, and these went over 500% as well. So that's the key, guys. Get a number that's close enough to where it's realistic, all right? The realistic one is potentially 135. Apple could potentially make it to 135 by May 7th. It could. Now, that's even pushing it a little bit. As you can see, these options prices get more expensive as you get closer to this number. So 133 is 93 and 100. Now, that's not even really a bad option as well. Implied volatility is relatively low. The open interest on these things are high. The volume's high on them. And the delta, this is going to be the multiplier. Whatever the delta number is per dollar is going to be multiplied in. For every dollar it goes up. But as we get into this more and more and more, I'll show you guys the better setups for it. I'll show you which ones are going to make the most money and why. You're going to learn the Greeks better. You're going to understand a lot of different things when it comes to this, and especially selling options. All right, selling options can be very profitable. Most options, if held long enough, expire worthless. All right, it's going to expire worthless for most people. Okay, most of those options never reach that price. So selling options is the way not only to hedge your equity, but a way to make passive income on the side, just almost like a dividend in a way. And there's particular instances to where you're going to want to sell these things, and I'll show you guys exactly how and why. I've made over 100 different options that I've sold this year, and I haven't lost on any of them. Almost every single one of them was not favorable for whoever I sold the option to. But that's a very brief overview of it, guys. Just remember those key things, okay? The option needs to be close enough to where it can make it to it by that date. An option represents 100 shares of a stock for a cheaper price. And then also know the bid and the ask. Know that it needs open interest and volume. And then make sure to always look at that implied volatility, which is factored into the price of those premiums. These are just very, very basic things. I'm going to show you guys a couple trades tomorrow live. That way you can see it firsthand. I think it's a little easier. And if you're very, very new to options and you simply just want to get your feet wet with them, you can get some really cheap ones, okay? Just to get a feel for it. So I would buy this right here. And this has a chance to lose, but it's going to be very inexpensive, all right? Look at Waiter Holding. Look at all of its last earnings right here, and know that it's had some sort of run up or spike pre-earnings or after earnings every single time. We're sitting all the way down at support right now, and it has earnings coming within the next 8 days. Now, if you go to the options chain on this, a 2.5 call, which that's at 246 right now, is only $20, $20 to $25. Okay, I would buy one of these, get a feel for it. I think this will go to 3+ easily, and you can see that just moving down a couple cents. You know, this thing is moving almost 20% just on Friday. So I would snag one of these up just to give it a try. You can even go slightly out of the money, like a $3 call. If you can get that one for around $10, I think it's a good buy. So I typically don't trade options for penny stocks very often, but when it does present itself with a good opportunity like that, you know, these ones are possible. Just look at this IV though, 100% plus on all of them, so you do have to factor these in. If this does trade sideways, the implied volatility is going to come down and your premiums will go down. But if you're simply just spending $25 or $50 on it to try it out, I think it's worth the buy. So any additional questions I'm going to answer on the next video. This one's already over 25 minutes long. So again, guys, very basic understanding of this just to try and help you guys out. Please leave comments below of anything that you want to learn on them or anything that I can show you guys on them. I'm going to be more than happy to help every single person on here. So it is my birthday today. We went out last night, so forgive me if I don't seem extremely enthusiastic right now. I'm a little tired. We all went out for my birthday last night with me and Emily. We had a great time. Went to a castle yesterday. Great dinner. So really great night. And tonight I'm just doing research for open tomorrow. So I appreciate all of you guys for the birthday wishes, and thank every single one of you that are watching here tonight. Please note that I'm not a financial advisor. I'm just a full-time trader who loves teaching, and we're growing this YouTube channel the best that we can, and the content will get better. I promise you guys. I'm going to work my tail off on it and make sure that I can give you guys everything that you want out of this channel. So again, thank you guys so much for joining, and I will see you guys tomorrow.